Our guest is David Burrows from Barometer, and we're talking about North American large cap stocks. And we're off to Orleans for Joseph. Hi, Joseph.
Hi, Michael. Thanks for taking my call.
Thanks for calling.
Question is on Stella Jones. I noticed it had a sharp drop yesterday and it's rebounding very well today. Is it a good time to take a position now? And what's the cause of the volatility? And or should I wait a little bit until the impending pullback to get in?
Right.
I'll hang up and listen to your take. Thank you.
Fell about 5% in the previous 4 days.
Well, Joseph, if you can tell me when it will fall in the future, that's something that we could talk about. Look, this is an interesting business. It's a very steady business. Stella Jones in the business of selling railway ties and utility poles. Good growth in both businesses, very steady contracts that they have. They are working their way through an acquisition that they made in the utility pole business. It's given them very good revenue growth this year, so certainly it certainly helped the shares. But you need to know, if you looked at the leading stocks, and this is one we don't own. I wish we did, because it's been a wonderful year for the stock. Mm-hmm. If you look at the stocks that have led the market all year, they held in very well over the last couple of weeks where you saw market weakness. But in the last couple of days, people were taking profits in leading stocks. And you saw a lot of the leading stocks pull back. Having said that, today, on the first sign of strength, many of the leading stocks south of the border and north of the border are having big rebounds. So that tells you that there was some throwing in of the towel on leading stocks. There are good buyers underneath the surface. This is a company that's it traded sideways sort of in the $100 range, $198 to $102, $103, sort of all summer long. It broke out of that range, it's pulled back into the breakout point. I think this is probably a good entry point for the stock.
I noticed that it's got a dividend yield that's less than 1% at 20 cents. Is there a point at this point?
Yeah, well, this has been more of a growth story. You know, their estimate for this year is for a 20% growth rate. Next year is close to 20%. It's an attractive company with a pretty stable, visible business.
Okay. Thank you, Joseph, for the call from Orleans. Let's go to St. Catharines now for Ron. Thanks for holding, Ron. Welcome to Market Call.
Yeah, good afternoon, gentlemen. Great show.
Thank you.
My question is on National Bank. Mm-hmm. I have a position in National presently, and I'm thinking of adding to it at these levels. I'm just wondering what David's recommendation would be if it's a good entry point at these levels.
Sure.
Thank you very much.
Would you under, equal, or overweight a bank like National in a portfolio?
Well, I think that National has an attractive franchise. We own some National, we own some TD, we own some Royal. We own more U.S. financials exposure than we do Canadian exposure. Mm-hmm. But it's a funny thing, in the Canadian market right now, the banks are benefiting from the fact that things are so bad in some of the other sectors that there is money yet to be put to work, and it's finding its way into banks. I think that probably the scope for dividend increase in the Canadian banks is less so than you'd see in the U.S. Mm-hmm. But I think that National looks pretty good. They recently acquired the institutional services business from TD, which will help them in their their wealth services business. Mm-hmm. So I think that if you own the stock, I'd continue to own it. I think you could buy it here. Certainly, it is benefiting from flows from other sectors.
Okay. And as far as a weighting in a model portfolio, would you be equal weighting banks right now? I can't imagine you'd be suggesting we overweight them.
No, we're about an equal weight. I think that in some of the portfolios we're 16-17% financials. But having said that, we have more exposure to the asset managers than banks themselves, because we do think there's more upside. We are more bullish on equity markets, so we think that they can benefit a little bit more.
Thanks, Ron, for the call from St. Catharines. Let's go to London now for Jeff. Jeff, welcome to Market Call. Hello.
Hi, thanks for taking my call. Mm-hmm. My question is for IGM. I just wondered, it's had a nice run over the last year, up about 33%. I just wonder, and it's having troubles breaking the $50 mark. Where do you see it going from here? Thanks very much, and I'll hang up and listen.
All right, just broke resistance on the 50-day moving average.
Well, you'd think that you were just listening to the last question. We talked about asset managers. We own both IGM and CI Financial. We think both are benefiting from money slowly rotating back into equities. In general, investors are underweight equities after many years of difficult markets. And I think that both of these companies will benefit going forward. If I had to pick one, I'd probably pick CI over IGM. Mm-hmm. But we also like other asset managers in Canada and in the U.S. It's not impossible that after many years of difficult equity markets, we could have smoother sailing going forward. So I think certainly they have benefited from a little bit of relief in asset managers, but I think that you are going to see pretty good flows into equities going forward.
So how much more upside do you see? Because I see it's already pushing 3 on the price to book ratio, and as Jeff points out, it's already up about 36% in the last year.
Look, we've spent 13 or 14 years seeing money work its way from equities to debt instruments. Mm-hmm. And we've only really begun to see some rotation back from debt instruments into equities. So there could be a very long runway here, many, many years. Mm-hmm. And I don't think these stocks are terribly expensive. So, pick your spots, understand that, we're going to get news flow that makes things choppy through the fall. But, really, here we are almost the middle of October, which is at the end of the seasonally weakest period of the year. Mm-hmm. Credit markets are actually pretty resilient. You can see that with the first whiff of good news, markets are prepared to rally. I think that there's upside in equities and asset managers.
We're going to take a brief break. Jeff, thanks for the call from London. David Burrows is here. He's the president and chief investment strategist at Barometer Capital Management. We're taking your questions on North American large caps at 1-855-326-6266. When we return, we'll talk about Carl Icahn's new favorite stock.